What's up, guys? This is the Broke Executive, and I'm here today to teach you about ETFs, how you can make other people work for you, and how to use ETFs to create diversification within small accounts to help minimize your risk exposure to certain companies and how their stock could possibly end up performing. So without waiting much longer, let's just dive right in. An exchange-traded fund, or ETF, is a collection of stock holdings offered by a company. These ETFs are managed by professional investors who are certified in what they do, and they often have a very specific goal in mind. For example, the Vanguard ETF, VOO or VOO, is set up to track the S&P 500, which is the top 500 companies in the US. And as a result, it has a very similar performance to the S&P 500 index. Now, these ETFs can have a large variety or a small variety of stocks covering all sectors or a specific sector. There are ETFs that cover just the airline industry, like JETS, GETS. Or it could just cover the overall US stock market. Vanguard's ETF for the total stock market is VTI. These ETFs do not have a limit to how many stock holdings they could potentially have. Some of them only have a couple, whereas others go up to close to 4,000. Vanguard's total stock market index for VTI has about 3,800 holdings, so as a result, you're able to buy into 3,800 different companies for a much smaller price. I know what you're probably thinking, if there is an active portfolio manager, people and investors who are constantly looking into companies that should be and could be in this ETF, does it cost anything? And the answer is yes. All ETFs have what's known as an expense ratio. This is a percentage based off of how much money you have invested for how much you pay. Expense ratios are often less than about 0.5%, although they can be higher for some, but the majority of which are below that 0.5%. And that works out so that there's not a flat fee or a flat commission that you have to be paying in order to be a part of these ETFs. So as a result, you're able to get your money in and invest it much easier, as well as these expense ratios are often so low that small accounts do not end up paying more than fractions of a penny in the first place. These expense ratios are calculated based off of the amount of money it costs to run that fund. So you're looking at paying all the people who run the fund, as well as your tax implications for when you're selling stocks and have to pay capital gains taxes, divided by the total amount of assets, so money sitting in cash as well as the total amount within stock holdings. And that is how you get these low expense ratios, because many companies, specifically Vanguard, have billions upon billions in assets under management. Most Vanguard expense ratios are about 0.03%, which means for every $10,000 you have invested with Vanguard, you'd be paying roughly $3 per year. That's how small accounts end up paying fractions of a penny, and it becomes essentially like a free investment. Now, I'm sure you're wondering how I was able to use dividend investing in ETFs at the same time, and how I was able to help grow my portfolio when it was such a small value. And that's very easily answered by saying there are ETFs that track and focus on dividend-paying stocks to help create that passive income flow. You can find dividend ETFs that start at a cost of around $30 and still have a very low expense ratio, as well as you can use Vanguards, which are a little more expensive, but you can capitalize on such a low expense ratio. So it really comes down to how much money you have, how much you want to put in, and ultimately what ETFs you personally think are best for you and your interests. These dividend ETFs still experience the same growth that the stock market does, as well as some dividend ETFs can actually outperform the same company's overall stock market ETFs, just because these dividend companies tend to be very reliable companies that perform well over many years. The Motley Fool actually published a study and a graph to go along with it that I'll show you guys in just a second that shows how 3 different Vanguard ETFs performed over the course of the first half of 2017. So you can see right here, going from bottom to top in terms of overall performance, that bottom line is the Vanguard High Dividend Yield ETF, which is VYM. They were able to return a 2.4% return over 6 months, as well as pay out their dividends twice in that time frame. Moving up to the red line, that is the Vanguard Total Stock Market ETF, or VTI, that I mentioned earlier. It was able to return a 6.64% return and pay 2 dividends in that time as well. Then the top performing one, which returned 7.5%, is the Vanguard Dividend Appreciation ETF, or VIG, which was also able to pay out 2 dividends in that time. Now, if you're thinking, oh, well, if all of them paid out 2 dividends, what's the advantage of having a dividend ETF versus the total stock market ETF? And that answer is quite simply the dividends paid are higher. So for the high dividend ETF, this blue line right here, obviously that one grows slower. However, it is a much more secure form of passive income because the dividends are higher. So as a result, you are not forced to rely on stocks being able to go up over time, and as a result, you can have a much more steady form of income over the long term. So I currently hold 5 ETFs. I own VTI and VOO, and that's because I figured at a younger age it's much better for me to be able to capitalize a little bit on growth as well as still collect that dividend. So I was willing to sacrifice the higher dividend payments because I felt throwing in a little bit of growth to my portfolio would be good, and it does help keep me close to how the stock market overall performs. So if there were companies that start underperforming because they're so busy trying to focus on that dividend, it does help give my portfolio some stability and help keep it roughly in line with what the stock market does. And then I own 3 dividend ETFs, which I'll be able to show you guys, as well as I can show you the prices so you can understand that not all of these ETFs are expensive, as well as show how these ETFs being cheaper are better suited for smaller portfolios, which will allow you guys to be able to start your portfolios in much the same manner that I started mine. So I'm going to be going in no particular order. So the first one I have is SCHD. You can see the 5-year graph right behind me. They've yielded about a 65% return over the past 5 years, which is pretty good, as well as they pay about a 3% dividend, which comes out to be about $1.72 per share per year. This company pays out 4 times a year. The most recent one was at the end of June. They paid out 44.2 cents per share, and that dividend is consistent with their previous payment. So this next one is SPYD. If you notice right here over my little shoulder, it is only about 5 years old, and that's why it is currently in the red, mostly in part because of the whole mask thing. But you will notice it's only down a little bit, as well as this company does pay a 6% yield, which comes out to be about $1.75 a share. So if you did buy it right around this point in time, that $1.75 per share would have you in the green overall. So it's not a huge deal that it's lower, as well as do pay 4 times a year. So SPYD also paid at the end of June, and they paid 36.6 cents per share, and I currently own 3 shares. And yes, I am in the red right now. However, thanks to those dividend payments, it's not as bad as it looks when you just look at my overall net return for owning the stock and buying it when I did. And again, this is one of those companies I bought towards the top right before they had their big drop, and as a result, I am in the negative, but with them constantly paying dividends, it makes me feel much better about owning the company at this specific price. So I'm not worried about it. And this last dividend ETF I own, which is SPHD, is, if I had to pick, probably my favorite, but not for the reason you might think, because if you do notice, it does have a much lower yield. Also, because of the whole mask wearing thing, it's fairly close to break even, but that's not something I'm really concerning myself with, because this company pays about 5.5% in terms of a dividend yield, which works out to be $1.85 per share per year. Now, the reason I like this company is because, unlike paying quarterly, they actually pay monthly. So instead of seeing 4 larger dividend payments, you get to see 12 dividend payments spread out across the year. So it pays about 15 cents every month. And when you have a smaller account and you're trying to just get into the feel of dividend investing, you want to be able to see those dividends start coming in, and you want to it really helps convince you that what you're doing can in fact create a passive form of income. So being able to receive those dividends every month really helps, and that's one of the primary reasons why I initially noticed this ETF, as well as being able to get those dividends consistently really helped jumpstart me and make me want to get more into the dividend focus. That's why I was more willing to look into this dividend investing, and it really helped jumpstart me in focusing on dividend paying stocks. And from there, I've purchased a couple other ETFs that do in fact pay monthly, but primarily I do own the quarterly ones now, because I felt just trying to focus on companies that pay monthly was really limiting and hindering my ability to find good companies that I wanted to invest in. Alright guys, with that you should have enough information to be able to start buying ETFs for dividend investing and kind of jumpstarting your portfolio almost exactly the same way I was able to jumpstart mine. If you do own any ETFs, whether they're dividend paying or non-dividend paying, please drop a comment down below and let me know which ETFs you own and just a quick explanation, oh, I bought this ETF because I felt this industry was going to do really well, or I own VOO because it follows the S&P 500, and that's the investment advice I got because that is the most hands-free way to invest your money and let it grow over time. Just let me know what you own, why you own it, and I can continue explaining why I own what I own. So next week I'm going to be doing a portfolio review and update for my own portfolio because with the first of the month I will be buying new shares of companies, and I think you guys are going to be a little impressed with the company I've decided I want to buy into, especially with the timing that I am buying it at. I feel it's going to set myself up really well for how the company is going to do, as well as their dividend has been proven to be one of the upcoming dividends that people are going to want to be buying into for the reason of how big this company is. So make sure you subscribe to the channel so you can see that video when I post it next week, as well as remember to like this one. Hop over to the Broke Executive subreddit. I will have the link below in the description as well. Make sure you follow me on my social media. I have the Broke Executive Instagram page as well as my own personal Instagram page, just so you guys can kind of keep up with what I'm doing and why I'm doing it. I'll be posting a teaser screenshot on the Broke Executive Instagram page, so if you want to find out what company I buy before the video goes live, make sure you follow me on there. And I'll see you executives in the next video.